Look, I need to show you something that's happening in the silver market right now that most people aren't paying attention to. And I'm going to be direct with you because time matters here. There's a pattern developing in silver that I've only seen twice before in my career. Once in 2010, right before silver went from $18 to $49 in less than a year. And again in early 2020, just before it doubled from $12 to $26 in 5 months. Both times, the people who recognized what was happening and positioned themselves made extraordinary returns. The people who waited, who said, "I'll get in when I'm sure." They watched from the sidelines as the opportunity passed them by. Right now, we're seeing that same pattern again. And here's what concerns me. The window is narrower this time. Let me walk you through exactly what's happening, because this isn't speculation. This is about reading the market structure, understanding the forces at play, and recognizing when all the pieces are aligning in a way that creates explosive moves. Silver closed Friday at $31.47. That number matters because of where it sits relative to some critical technical levels. But more importantly, it matters because of what's happening beneath the surface in the physical market, in the derivatives market, and in the behavior of the institutions that move billions of dollars in and out of these metals. Start with the physical market. The U.S. Mint sold 4.2 million Silver Eagles in October. That's the highest monthly total since March 2020, when the pandemic panic was at its peak. But here's what makes this different. In 2020, people were buying because they were scared. They were hoarding. This time, the buying is more calculated. It's strategic. And it's coming from a different type of buyer. I'm seeing reports from dealers across the country of premiums widening. Not dramatically. Not in a way that makes headlines, but steadily. When you call a major dealer right now to buy 1,000 ounces of physical silver, you're paying $3.50 to $4 over spot. 6 months ago, that premium was $2.50 to $3. That spread is telling you something. Physical demand is outpacing the ability of the market to deliver metal efficiently. Now layer in what's happening in India. India is the world's largest consumer of silver for industrial purposes. Their solar panel manufacturing has increased 47% year over year. Every solar panel requires about 20 grams of silver. Do the math on India's solar expansion plans through 2030, and you're looking at an additional 150 million ounces of annual silver demand just from that one country, just from that one use case. That's roughly 15% of total global mine supply. But it gets more interesting when you look at what's happening in the derivatives market. The COMEX silver futures market is showing something unusual. Open interest has been climbing steadily over the past 6 weeks, but the price has been relatively stable. That divergence tells you that positions are being built. Big positions. The kind that don't get unwound easily. Commercial traders, the banks and institutions that typically short silver to hedge their physical positions, have reduced their short positions to levels we haven't seen since 2019. The COT report from last Tuesday showed commercial shorts at just 42,000 contracts. For context, in 2020 before the big move, they were at 38,000 contracts. In 2010, they were at 35,000. We're in that zone now. What does that mean in practical terms? It means the usual sellers, the ones who provide liquidity and cap rallies, have less ammunition. When silver starts to move, there's less resistance. And when there's less resistance in a market with growing physical demand, prices don't just rise, they surge. Let me tell you about what happened in 2010 because the parallels are striking. Silver had been trading in a range between $16 and $20 for most of 2009 and early 2010. The mainstream financial media wasn't talking about it. Gold was getting all the attention. But underneath, something was building. Industrial demand was recovering from the financial crisis. Solar panel production was ramping up. Electronics manufacturing was expanding. And at the same time, investment demand was starting to wake up. The SLV ETF, the big silver exchange-traded fund, started seeing consistent inflows. Not massive, not headline-grabbing, just steady accumulation. Then in August 2010, silver broke above $20. And once it did, everything changed. The move from $20 to $30 took just 3 months. From $30 to $40 took another 2 months. And the final push from $40 to $49 happened in less than 3 weeks. The people who bought at $18 and $19, when it felt like nothing was happening, they made 170% returns in less than a year. But here's what most people don't remember about that move. There were multiple opportunities to get in. Silver didn't just go straight up. It would rally, consolidate for a few weeks, then rally again. The people who made the most money weren't the ones who timed the absolute bottom. They were the ones who recognized the trend early and stayed with it. Right now, we're in a similar setup, but with some key differences that actually make this more compelling. In 2010, central banks weren't buying silver. They were selling gold. Today, central banks bought a record 1,037 tons of gold in 2023, and they're on pace to exceed that in 2024. That matters for silver because historically, when gold enters a sustained bull market driven by central bank buying and monetary concerns, silver follows with even more volatility. The gold-to-silver ratio right now is sitting at about 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. The historical average over the past 30 years is closer to 65 to 1. In the 2011 peak, that ratio compressed to 31 to 1. Even if we just revert to the historical average, silver needs to outperform gold by about 30%. If we see the kind of compression that happens in real bull markets, silver could outperform gold by 100% or more. Now, I want to pause here for a second because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs work, and it covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. A lot of people don't realize this is even possible, but it's a legitimate way to add metals exposure to your retirement portfolio. Worth checking out if that's relevant to your situation. All right, back to what's happening in the market right now, because there's another piece of this puzzle that's critical to understand. China has been quietly accumulating silver. Not through official channels, not in ways that show up in the headlines, but through private sector buying and through their strategic commodity reserves. Chinese solar manufacturers are now the dominant players globally, controlling about 80% of the world's solar panel production capacity. Every single one of those panels requires silver, and China has made it very clear through their 5-year plan that renewable energy is a national priority. But there's a supply problem. Global silver mine production has been essentially flat for the past 5 years, hovering around 830 million ounces annually. Meanwhile, total demand, industrial plus investment, has been running at about 1.1 billion ounces. That deficit is being filled by above-ground stocks, recycling, and selling from existing holders. But those sources aren't infinite. The Silver Institute's latest report projects that the supply deficit will widen to 215 million ounces in 2024. That's the largest deficit in decades. And unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed. It goes into electronics, into solar panels, into medical applications, and it doesn't come back. About 60% of silver demand is industrial, and that percentage is growing. Here's where it gets really interesting from a market structure perspective. The COMEX, the exchange where silver futures trade, has about 300 million ounces of silver in its registered vaults. That's the metal that's available for delivery against futures contracts. Sounds like a lot, right? But open interest in COMEX silver futures represents claims on about 900 million ounces. That's a 3-to-1 ratio of paper claims to physical metal. Now, most of those futures contracts get rolled or cash settled. They don't result in physical delivery. The system works as long as everyone plays by the unwritten rules. But what happens when a large buyer decides they actually want physical delivery? What happens when multiple buyers decide that at the same time? We got a preview of this in March 2020. The silver futures market went into backwardation, meaning near-term contracts were trading at a premium to longer-dated contracts. That's not supposed to happen in a commodity market. It's a sign of physical tightness. And during that period, the spread between paper silver prices and physical silver prices blew out to $6 or $7 per ounce. If you wanted to buy physical silver, you were paying $20 when the futures were trading at $14. That dislocation eventually corrected, but it revealed something important about the market structure. When physical demand surges, the paper market can't always deliver. And when that happens, prices have to rise to ration the available supply. Fast forward to today, and we're seeing early signs of that same dynamic. Premiums are rising. Delivery times are extending. Some products are going on allocation. These aren't crisis-level signals yet, but they're yellow flags. They're telling you that the physical market is tightening. Now add in what's happening with investment demand. The SLV ETF has seen inflows of about 35 million ounces over the past 3 months. That's significant, but it's not the massive inflows we saw in 2020. What's different this time is the type of investor who's buying. In 2020, it was retail panic buying. This time it's more institutional. It's family offices. It's wealth managers adding metals exposure to diversified portfolios. I had a conversation last week with a wealth manager who oversees about $800 million in assets. He told me that 6 months ago, none of his clients were asking about precious metals. Now, about 30% of them are. They're not looking to put their entire portfolio into silver. They're looking to add 5 to 10% exposure as a hedge against monetary instability and inflation. But when you multiply that across the wealth management industry, that's billions of dollars of potential demand. And here's the thing about institutional money. It moves slowly at first, then all at once. Institutions don't chase, they accumulate. They build positions over time. But once a trend is established, once the narrative shifts from alternative investment to necessary portfolio component, the flows accelerate. We're seeing that narrative shift happen right now in real time. 6 months ago, if you mentioned silver in a mainstream financial publication, you'd get eye rolls. Today, Bloomberg, Reuters, and the Wall Street Journal are running regular stories about metals, about central bank buying, about the supply-demand dynamics. The narrative is changing. Let me tell you about what happened to a friend of mine in 2020. He's a small business owner, runs a manufacturing company, does well for himself. In March 2020, when everything was falling apart, he called me and said, "I think I should buy some silver." I told him the same thing I'm telling you now. Look at the fundamentals, look at the market structure, and if it makes sense for your situation, don't wait for the perfect entry. He bought 5,000 ounces at an average price of about $15. Not at the absolute bottom, which was around $12, but close enough. By August, silver was at $26. He sold half his position, took his initial investment off the table, and let the rest ride. That remaining 2,500 ounces is still worth more than his entire initial investment, even at today's prices. And more importantly, he didn't stress about timing the bottom perfectly. He recognized the opportunity and acted. The lesson there isn't about getting rich quick. It's about recognizing when the risk-reward is skewed in your favor and having the conviction to act on it. Right now, with silver at $31, with the supply-demand fundamentals tightening, with institutional interest building, with the technical setup showing reduced commercial short positions, the risk-reward is compelling. But here's what concerns me about the current setup. The window feels narrower this time. In 2010, you had months to accumulate before the big move started. In 2020, you had a few weeks after the initial crash. This time, the market is already aware. The information is out there. The institutions are already positioning. The retail investors who pay attention are already buying. What's missing is the mainstream recognition. The moment when silver breaks through a key psychological level, when it starts making headlines, when your neighbor asks you about it. That's when the real move happens. And that moment could be triggered by any number of catalysts. It could be a geopolitical event that drives safe haven demand. It could be a major industrial buyer announcing a large purchase program. It could be a technical breakout that triggers algorithmic buying. It could be a supply disruption at a major mine. Or it could simply be the steady accumulation of physical metal finally overwhelming the paper market's ability to suppress prices. The specific catalyst doesn't matter as much as being positioned before it happens, because once silver starts moving, once it breaks above $35 and then $40, the psychology changes. At $31, people are skeptical. At $40, they're interested. At $50, they're convinced. And by the time silver is making new all-time highs above $50, the easy money has already been made. I'm not saying silver is going to $50 next week or next month. I'm saying the setup is there for a significant move higher over the next 12 to 18 months. And the people who position themselves now, who buy physical metal or add exposure through vehicles like PSLV or mining stocks, they're the ones who will benefit when that move happens. Let's talk about the mining stocks for a minute, because this is where the leverage really comes into play. When silver moves from $31 to $40, that's about a 30% gain. But a silver mining company that's producing at $20 per ounce sees their profit margin expand from $11 to $20 per ounce. That's an 80% increase in profitability. And the stock market tends to price that in with a multiple, so a stock might move 100% or 150% on a 30% move in the underlying metal. The challenge with mining stocks is picking the right ones. You want companies with low production costs, strong balance sheets, and growth potential. You want management teams that have been through previous cycles and know how to operate in both good times and bad. And you want to avoid the companies that are over-leveraged or have operational issues. But if you get it right, the returns can be extraordinary. In the 2010-2011 silver bull market, some of the best-performing silver miners went up 300% to 500%. In 2020, the moves were smaller but still significant, with many quality names doubling or tripling. The key is having exposure before the move starts, because once it's obvious, the easy gains are gone. Now, let's address the elephant in the room. What could go wrong? What are the risks to this thesis? The biggest risk is a deflationary collapse. If we see a 2008-style credit crisis, where everything sells off and cash becomes king, silver will likely get hit in the initial panic. It happened in 2008, when silver dropped from $20 to $9. It happened in March 2020, when silver briefly touched $12. In a liquidity crisis, everything correlates to one, and precious metals aren't immune. But here's the difference between now and those previous crises. Central banks have shown their hand. We know they will print money. We know they will intervene. We know they will do whatever it takes to prevent a deflationary spiral. And in that environment, once the initial panic passes, precious metals are where you want to be. The second risk is a genuine resolution to the monetary instability that's driving metals higher. If somehow the Federal Reserve and other central banks figure out how to engineer a soft landing, if inflation comes down without a recession, if the dollar strengthens sustainably, then the case for silver weakens. But look at the debt levels. Look at the deficits. Look at the political incentives. The path of least resistance is more money printing, more inflation, more monetary instability. And in that environment, silver thrives. The third risk is a major technological shift that reduces industrial silver demand. If someone invents a solar panel that doesn't require silver, or if electronics manufacturers find a cheaper substitute, that changes the equation. But silver's unique properties, its conductivity and reflectivity, make it very difficult to replace in most applications. And even if substitution happens, it takes years to implement at scale. So when I weigh the risks against the potential rewards, when I look at the supply-demand fundamentals, when I see the market structure and the institutional positioning, I come to the conclusion that the risk-reward is skewed heavily in favor of being long silver right now. But here's the critical part. You need to act before the next market open. Not because the world is ending, not because there's some imminent crisis, but because the setup is there and the window is narrowing. Every day that passes, more institutions are positioning. Every week, more physical metal is being accumulated. Every month, the supply-demand deficit widens. The people who make money in markets aren't the ones who wait for certainty. They're the ones who recognize probability, who understand when the odds are in their favor, and who have the conviction to act on that understanding. Right now, the odds favor silver moving significantly higher over the next 12 to 18 months. So what should you do? If you don't own any silver, consider starting a position. If you already own some, consider adding to it. If you're not sure how much to allocate, start with an amount that lets you sleep at night, but gives you meaningful exposure if the thesis plays out. For most people, that's somewhere between 5% and 15% of their investable assets. You can buy physical coins or bars through reputable dealers. You can buy shares of PSLV, which is backed by physical silver stored in Canada. You can buy a basket of quality silver mining stocks. Or you can do a combination of all three. The specific vehicle matters less than having exposure. And then, once you're positioned, be patient. Silver doesn't move in a straight line. There will be pullbacks. There will be days when it feels like nothing is happening. But if the thesis is correct, if the fundamentals play out the way they appear to be setting up, those short-term fluctuations won't matter. What will matter is that you recognize the opportunity and acted on it before the crowd figured it out. The next market open is your opportunity. The setup is there. The fundamentals are there. The technical structure is there. The institutional positioning is there. All the pieces are in place. The question is whether you'll recognize it and act, or whether you'll look back 6 months from now and wish you had.